The 6 billion riddle: how can one sale benefit everyone? As students, before you try to understand a business, a balance sheet, or even a stock chart, you must understand something far more fundamental: how money moves. Money has a trail. It always tells a story. And sometimes the trail is far more interesting than the headline. Today's story begins with a simple headline: SoftBank sells 6 billion of Nvidia stock. Now, ordinarily, a sale like that raises familiar questions. Who won? Who lost? Did someone know something the rest of us didn't? That's how most people think about transactions. But in this case, something unusual is happening. This 6 billion appears to have been arranged in a way where every major player, SoftBank, OpenAI, and even Nvidia, could walk away smiling. When you see something like that, don't rush to judgment. Just slow down and ask the most important question in finance. What incentives are at play here? Let's start at the beginning. SoftBank decided to liquidate a large portion of its Nvidia position. Normally, if you unload billions of dollars of a stock, you might create short-term pressure on the share price. Markets don't like sudden supply. But SoftBank didn't do that. They didn't sell and sit on cash. They didn't rotate into bonds. They didn't hedge. Instead, they appear to be redirecting almost the entire $6 billion straight into OpenAI, a private company. Now, let's pause there. This is your first lesson in modern valuation in private markets. A large investment isn't just capital. It's a signal. When a major investor sells something successful and immediately pours the proceeds into another company, the market reads that as a vote of confidence. It doesn't just give OpenAI money. It gives OpenAI a story. SoftBank left a winner to back an even bigger winner. Nothing raises a private valuation faster than a story like that. But here's where your investor caution should begin. Ask yourself, is this genuine value creation? Or are we watching capital being rearranged in a way that conveniently lifts valuations across an entire ecosystem? Because the moment SoftBank's money lands at OpenAI, the valuation of OpenAI climbs, not because of new revenue, new products, or new breakthroughs, but because a large check cleared. Now, I want you to notice something else. SoftBank didn't just give OpenAI money. They gave OpenAI money that used to be Nvidia money. And what does OpenAI need to operate at scale? Nvidia chips. Lots of them. So the same dollars that exited Nvidia may soon return to Nvidia as OpenAI spends on AI infrastructure. This is why I ask you to follow the flow of capital carefully. Sometimes the same dollar can appear to do multiple rounds of value creation simply by moving through the right hands. We've just covered the first step of the circle: SoftBank, OpenAI. The second step, OpenAI to Nvidia, is where the loop gets interesting. Because when dollars return to the company they originally came from, and valuations go up at every stop along the way, you must ask yourself, are we witnessing true business growth, or are we witnessing the modern version of financial alchemy? Don't answer that yet. We're only at the beginning of this case study. But keep the question in mind as we follow every penny of this 6 billion. Because in great businesses, value is created. In weaker ones, value is manufactured. And your job as an investor is to know the difference. The OpenAI valuation explosion, real growth, or financial sleight of hand? Students, now that we've followed the first leg of the journey, the 6 billion SoftBank sale of Nvidia shares, and the immediate reinvestment into OpenAI, it's time to pause and ask a very simple question. Does receiving 6 billion automatically make a company worth 6 billion more? If your instincts are sharp, the answer should already make you uneasy. In private markets, price and value can drift apart more easily than in public markets. When SoftBank writes a 6 billion check to OpenAI, the number itself becomes a signal, and signals can move valuations faster than earnings ever could. But remember something I tell investors all the time: cash is not a business model. OpenAI's valuation rises the moment this money lands, not because their revenues doubled, not because their profits surged, but because a major investor decided to reallocate capital. That may create excitement, but excitement and economics are two very different things. Now, Let's look at the incentive structure. SoftBank effectively said to the world, "We'll believe the future return from OpenAI exceeds the return from holding Nvidia." That's a powerful narrative. Investors love narratives. Private valuations, especially in hot sectors like AI, can move billions on narrative alone. But as value investors, we must ask the question the headlines don't. Is this money being deployed to create future cash flows, or merely to elevate today's perception of value? Because the value of any company, OpenAI included, comes from the earnings it will generate over decades, not from a single cash infusion. Now, here's where the loop gets interesting. This $6 billion didn't arrive to sit idle. OpenAI needs enormous computing power to train large language models, and the supplier of that computing power is overwhelmingly Nvidia. So you have capital flowing in a straight line: SoftBank, OpenAI to Nvidia. Notice what just happened. SoftBank exits Nvidia, OpenAI's valuation rises, Nvidia receives revenue from OpenAI, and Nvidia's financials strengthen. The market rewards Nvidia again. $1 has now produced multiple value signals without producing a single new product or customer. This doesn't make the companies dishonest. It simply reflects the nature of the modern technology ecosystem, large players reinforcing each other's valuations through coordinated capital allocation. As an investor, you must recognize the difference between two things: real revenue, money earned because customers demand your product; circular revenue, money that reappears because capital was intentionally routed through a controlled path. The concern isn't that something improper is happening. The concern is that investors might mistake circular capital for genuine market demand. Because if revenue is predetermined by investment flows rather than customer choice, you're not measuring competitive strength, you're measuring financial engineering. So keep your eye on that $6 billion. It has one more stop to make. And when it finally shows up on Nvidia's financial statements, you'll see the full shape of the loop and understand why disciplined investors must separate valuation from validations. Nvidia's double dip. How does a company profit from a stake it just lost? Students, now we arrive at the most interesting part of this entire cycle, the moment when the dollars, having traveled through multiple hands, find their way back to Nvidia. And here's the question a disciplined investor should ask: how can a company benefit financially from the very dollars that exited through the sale of its stock? On the surface, it looks contradictory. When a large investor like SoftBank sells billions of dollars worth of shares, you often expect two things: a short-term dip in the stock price, a reduction in long-term shareholder stability. But markets don't operate on surface-level logic. They operate on incentives. And when you follow the incentives in this situation, you'll see something unusual. The very money that left Nvidia's shareholder base is now preparing to reappear as Nvidia's revenues. Let's walk through how that works. OpenAI, now holding SoftBank's $6 billion infusion, has a straightforward need: computing power, and not the everyday kind. They need the world's most advanced GPUs, networking systems, and infrastructure. In other words, they need Nvidia. No one else sells the high-end hardware required to train frontier models at the scale OpenAI operates. So this capital, once removed from Nvidia shares, is now likely to become a purchase order directed right back to Nvidia. If you're thinking about this in business terms, the picture becomes clearer. SoftBank exits as a shareholder. OpenAI enters as a customer. Nvidia trades a financial investor for a revenue-producing client. And from Nvidia's perspective, that's a very favorable trade. Investors don't drive earnings. Customers do. A company doesn't improve because a shareholder buys or sells shares. It improves when someone buys its products. And OpenAI isn't just any customer. It's one of the largest, most consistent buyers in the AI ecosystem. So Nvidia, instead of worrying about the sale, can now record billions in new orders, high margin hardware sales, predictable revenue, improved earnings visibility. And when earnings rise, the market tends to reward the company with a higher valuation. Now I want you to notice the structure here, SoftBank. OpenAI and Nvidia earnings and Nvidia stock strength. The same 6 billion produces a sale evaluation bump, a revenue event, and then a market cap increase. That's a remarkable chain reaction from a single pool of capital. This is not market manipulations. It's simply the financial reality of large ecosystems where partnerships, incentives, and strategic capital flows overlap. But there is a lesson here. As outside investors, without board seats, private information, or direct access to these cycles, we must remember what looks like organic demand may sometimes be strategic demand. That doesn't make it bad. It just means you should understand why the revenue is appearing, not just how much. Because in industries experiencing rapid technological growth, the relationship between capital and revenue can be tightly interwoven and sometimes circular. And as disciplined investors, recognizing those patterns helps us distinguish between true, broad-based market demand and revenue generated by capital recycling within a small group of dominant players. Next, we'll address the question every thoughtful investor eventually asks: at what point does strategic coordination cross into valuation distortion? And how should you navigate an environment where the biggest companies benefit from loops the public never sees? The line between strategy and distortion, when incentives start to mislead investors. Students, now that we have followed the entire 6 billion journey, from SoftBank's sale to OpenAI's valuation jump to Nvidia's revenue recognition, it is time to ask the most important question in this entire lesson. At what point does smart strategy become misleading to investors? Not illegal, not fraudulent, just misleading. Understanding that distinction is one of the most valuable skills you can develop as an investor. Let's begin with something very clear. This entire chain of events is almost certainly legal. Companies are allowed to allocate capital however they see fit. Large investors are allowed to buy and sell according to their preferences. And businesses are allowed to engage in partnerships that benefit both sides. So we are not talking about manipulation in a legal sense. What we are talking about is a pattern that can influence perceptions, sometimes faster than it influences fundamental results. You see, true manipulation involves deception, but financial distortion often involves something simpler: incentives aligned so tightly that the outcome becomes highly predictable. In this case, SoftBank frees up capital, OpenAI receives capital, OpenAI immediately needs Nvidia hardware, Nvidia books revenue, earnings look strong. The stock responds positively, no laws are broken. But the sequence creates a kind of valuation momentum that investors may mistake for organic demand. And that is where the risk begins, not in the boardrooms, but in the assumptions of outside investors. When a company's revenue comes from broad demand, it tells you something about the market. When it comes from coordinated capital flows among a small group of large players, it tells you something different: the ecosystem is reinforcing itself. That's not illegal, but it can obscure the difference between a strong business and a strong narrative. Let me give you a simple principle. When the same dollar seems to lift multiple valuations, you should slow down and ask whether that dollar came from customers or from structure. In this AI cycle, what concerns me isn't dishonesty, it's concentrations. When a few dominant players can orchestrate capital in a way that guarantees revenue for each other, the competitive field shrinks. The moat doesn't widen naturally, it's reinforced financially. And when that happens, smaller competitors face a higher hurdle, not because their products are worse, but because they can't participate in the same circular flows. As an investor, your job is to recognize that dynamic. Don't assume that a rising stock price always reflects rising demand. Sometimes it reflects rising coordination. And that doesn't mean you shouldn't invest. It just means you should do it with clarity, understanding the incentives behind the numbers, not merely the numbers themselves. The takeaway here is simple. Strategy becomes dangerous to investors only when it disguises risk as certainty. And your job as disciplined thinkers is to see through the structure and evaluate the business underneath. Next, We will look at what this loop means for the broader AI market and how retail investors should approach companies whose valuations may depend on capital cycles rather than customers. The future of AI capital, what this deal means for your investments. Students, now that we have followed the entire path of this $6 billion transaction, it's time to talk about what really matters. What does all of this mean for your investment decisions in the years ahead? Because the purpose of studying these complex loops is not to admire the cleverness of large institutions, but to understand the environment in which you are investing your own money. Let's begin with the central lesson. In today's AI economy, valuations are not always discovered strictly through the free market. More often, they are supported, reinforced, and sometimes accelerated by large players who have the ability to move capital in ways smaller investors cannot. That does not make the system unfair, but it does mean the rules have changed. In the early days of markets, valuations moved primarily on earnings and competition. Now, especially in fast-moving sectors like AI, valuations can move on narrative, on partnerships, and on capital cycles orchestrated by the biggest firms. In this case, SoftBank reallocated capital, OpenAI's valuation rose. Nvidia booked major revenue, Nvidia stock responded, and the cycle strengthened each player. This is not manipulation, but it is sophisticated strategy. And as an investor, your first responsibility is to recognize when strategy, rather than broad market demand, is driving the story. So how should a disciplined, Buffett-minded investor respond? First, when you see a company's valuation jump, ask the simplest question: is this demand coming from customers or from capital? If the new funding is largely destined to purchase hardware from one supplier, then the valuation bump may say more about structure than competition. Second, pay attention to concentration. In AI, a tight relationship is forming between companies that build the models and the companies that supply the chips. When the majority of new dollars in the ecosystem flow through a small set of firms, the ability of smaller players to compete diminishes sharply. That doesn't mean the future is closed, but it means the cost of entry is rising, and rising deliberately. Third, avoid assuming that every high valuation represents a long-term opportunity. Sometimes the number reflects cash cycling inside an ecosystem rather than true, durable earnings power. Buffett would tell you, your job is not to predict the future of AI. Your job is to understand the incentives behind the numbers. And finally, remember this: large firms now use capital not only to build products, but to shape perception, reinforce partnerships, and smooth earnings volatility. You don't need to criticize that, but you do need to recognize it, because valuation can travel in a straight line, even when value does not. So, as AI companies raise billions and deploy billions, don't focus solely on the headlines. Focus on the underlying forces. Where does the money come from? Where does it go? Who benefits at each step? And is the growth created or merely circulated? If you can answer those questions clearly, you will protect your capital far better than the investor who reacts to every headline. And that, students, is the real lesson of this $6 billion loop. The giants are playing a different game, but you can still win by understanding the rules.